Hi, this is Matthew Cratter from Trader University, and today I want to talk about how to pick the best dividend stocks for your portfolio. If you're interested in learning trading and investment techniques that will help you to make money in both bull and bear markets, be sure to hit that subscribe button. So a lot of people have been asking me about how to find the best dividend stocks, and this makes sense just because of the environment where we're in. You used to be able to take some of your cash and conservatively invest it maybe in a high yield savings account or maybe in US Treasuries. This chart shows that even a couple years ago you could get to almost 3% just investing in 2-year Treasuries, locking your money up for only 2 years. Now interest rates have moved down so much, you can see here that for the entire curve all the way from 1-month T-bills out to 30-year Treasuries, the long bond, you're still earning well below 2%, just 1.68% if you lock up your money for 30 years. You definitely don't want to do this because the inflation rate is at least 2%, so you'd be actually losing money on this. So we're going to talk about dividend stocks today. A really good place, to start is the Dividend Aristocrats, the S&P 500 Dividend Aristocrats. These are companies that have raised their dividend payouts for at least 25 years in a row. They're also members of the S&P 500. I'll link to this in the description notes below. This is a really good place to start fishing. They have a list of all of the companies, and there are a ton of them. Now, what we're going to be talking about is how to screen these companies. You don't want to invest in them blindly, in my opinion. General Electric used to be a member of this. It really destroyed a lot of investors' capital. We can see that ExxonMobil is still here. This has been a bit of a value trap where they've actually been borrowing money to pay their dividend. So in this video, I'm going to show you how to find really healthy companies that you can feel comfortable holding their stocks for a very long period of time and collecting dividends. So a good place to start is the S&P 500 Dividend Aristocrats. If you want to just go the ETF route, Noble, N-O-B-L, is an ETF. You can just buy this, and it's got currently a dividend yield of about 2.29%. We're not talking huge returns here from dividend investing, though you can actually get quite large returns if you hold for long enough. I'll link to my video where I discuss how Warren Buffett is making 50% per year on a dividend stock simply because he's been holding it for so long. But this Noble ETF is one place to start. You can buy this, just put it away. I think it charges a fairly low fee, 0.35%. And your yield, I think this is an after fee yield, will still be above 2%. This is very diversified. It's got all of these companies that were listed here, all these companies that have been raising their dividends for 25 years or more. We're going to talk in really broad terms here how to pick individual dividend stocks, and make sure you stay till the end because I'm launching a new service that's included as part of Trader University where you can actually follow along as I buy dividend stocks in my own account using $100,000 of my own money. So make sure you stay tuned to that. But I'm going to sort of show you parts of my process here so you can do this on your own even without subscribing. So the first key is to sit back and really think, is this company going to be around for the long term, or are there disruptors coming on the scene like Netflix was in the 2000s, going into maybe 2010 or so. I think that's roughly when Blockbuster filed for bankruptcy. If you have a company that pays a really high dividend yield, it's got a really low PE, it's got a name brand, that probably means that it's going out of business or there's some problem. A lot of people blindly bought Blockbuster without really sitting back and thinking, like, why would I ever drive to a store to get a video or DVD when I could just use Netflix? So you really want to think long and hard. Make sure you're not investing in a buggy whip company, a typewriter company, a fax company, or you name it. Technology is changing so quickly, which makes it a little bit more difficult. You don't want to be investing in a BlackBerry when the Apple iPhone is coming on the scene. And so that's one thing you always have to don't be seduced by really high dividend yields of companies that are going out of business. GE had a very high dividend yield before they massively slashed their dividend as well. So we're going to be looking at McDonald's. McDonald's is really the original fast food restaurant. I'm not saying you should eat there, maybe not the healthiest food, but it's been very healthy for investors. And the nice thing about McDonald's is with all these new delivery services like Grubhub, McDonald's really has come to the fore again. And it's a way that they can get some fairly high margin income, high margin revenue using these delivery services. So it does have these growth prospects. Nevertheless, it's a very established company. It's one of those brands that a 3-year-old kid in America probably recognize, and an 83-year-old person recognizes, maybe even worldwide. So we know it's an established company. And it's also a business we understand. If we have a highly technical business, maybe a biotech or a cutting-edge tech company, probably doesn't pay a dividend. But even if it does, we have to be sure that we understand what the company does. It's very clear what McDonald's does. They make their restaurant chain. They make food, and you either eat, you dine in, or you do takeout, or it's delivered using one of these new services. So then the next thing I do is I go to Yahoo Finance. I just type in McDonald's at the top here, and I take a look at the dividend yield. I'd say would be the first thing I'd look at. So the forward dividend yield is the yield you should earn if you hold the stock for the next 12 months. You always want to look at forward dividend yields, sort of think of those rather than looking at what you got paid over the past 12 months. Now, we don't always know the future, obviously, but if all goes well, McDonald's will pay $5 per share. You take $5 divided by 197.16 if you buy it here, and you get roughly a dividend yield of 2.59%, which is pretty good. It's not a super high yield, but it is a portfolio replacement for some of these more conservative investments like high yield savings and T-bills or treasuries. You just have to make sure that this is not something you're not going to need the money in 3 months or even 2 years. Obviously, stocks can be lower over short periods of time, even sometimes over longer periods of time. So if you needed this money and all of a sudden the COVID crisis hit and McDonald's stock went down 30% or whatever it did, you would have to sell at a loss. So I would say this is for capital that's fairly conservative, but you still want to have a long holding period. I always sort of make a note of the market cap, 146 billion here, actually a smaller market cap than Bitcoin at this point. I take a look at the PE ratio. It's less important in this environment simply because PEs are sort of permanently higher. Interest rates are sort of permanently lower. The Fed is capping them. If we saw a really high PE ratio, it might get my attention and I might want to dig a little bit more, but something in the 20s. This is being priced as a company that will continue to grow. It should have good growing revenues, good growing net income, and rising dividend payments. And it's got a reasonable dividend yield as well. Anywhere between 1% and 4% in this environment is fairly conservative. If you start to get above 4%, there can be weird things that are going on, and you may be at risk of a dividend cut. So you don't want to be too much of a yield hog. We'll be talking a little bit more about that in later videos as well. So dividend yield of 2.59%. Then what I do is I go to Morningstar, and I want to look for a history of rising dividends per share. I will link to this below, but it's just under dividends here. And we can see that we have the years here, 2015 through the last 12 trailing months, dividend per share. And we can see that it's a rising number. It's gone from about $3.44 a share. Every year it's ticked up, and now it's at about, for 2020, it's going to be at $5 per share. This is what conservative American countries do. As I understand it, in Asia and Europe, sometimes companies will just pay sort of a fluctuating dividend. But if you want to be a dividend aristocrat, if you want to get included in these indices, and you're managing a company like this, investors like to see a dividend that's slowly moving up over time, conservatively moving up. You can also look at buyback yield here, which takes into account share buybacks. I don't know if this is looking at net share buybacks, and you can get an idea of a total yield. So if this is in fact the total yield, it's actually not too bad, making 5.8% in this environment. But for now, we're just going to be focused on dividends per share. Make sure that the dividends per share are rising over time. Now, the next question is the dividend sustainable? Well, we can be pretty sure it's sustainable because we understand McDonald's, Apple, and Google and Facebook are probably not going to put McDonald's out of business. Maybe at some point we stop eating food and we take all our nutrition as pills, that could be a threat to their business model. But right now, it seems that people are addicted to their fast food, particularly in the United States. And so we want to look financially as well. Can they continue to pay the sort of dividend that they're paying? So if we look here, we can see that these are the dividends paid. I'm looking at the cash flow statement, which I'll link to below. This looks like a minus. There's a minus sign here. That's simply because there's cash flows out of the company. To investors, we can see the various years here, 2017, 18, 19. This is also a place to see that the dividend payment is rising. I use this other screen here to make sure dividend per share is rising, because if they're massively increasing the number of shares, the dividend per share will not be rising, even if the dividends paid will be rising. But what I'm really looking at on this screen is the amount of dividends that are paid. So we'll look at the last 12 months here. They paid $3.625 billion. All these numbers are in thousands, so you have to add 3 zeros to it. But they've paid $3.625 billion in dividends to their shareholders. And then what you want to see is to make sure that they have enough free cash flow to pay their dividends out of cash flow. Dividends are always, people talk about them as if they're paid out of earnings. Technically, they're a cash payment and they are paid out of free cash flow. Free cash flow is just the cash that the business spits off after accounting for capital expenditures and things like that, maintenance CapEx and growth CapEx. So in this case, free cash flow for this company is 5.286. So they have free cash flow of about $5 billion. They're paying out about $3.6 billion. They definitely are generating enough free cash flow in order to pay that dividend. And if we look for each year, we can see that the free cash flow number is well above the dividend payment number as well. So we know that the dividend has good coverage, as they say. They're generating enough free cash flow to pay the dividend. If you look at a company like ExxonMobil, which I think I did in another video, you'll see that they're actually, for many years, they have not been generating enough free cash flow to cover their dividend, and so they've been having to issue debt and make the company more risky by selling bonds and levering up the company. In this case, McDonald's very conservatively run, and their dividend payment is well within their means to pay it out of free cash flow. So we know that the dividend will continue, assuming they can keep selling Coke fries and hamburgers. Next, I take a look at the operating performance. This is from Morningstar here. It's under the operating performance tab. I'll also link to this below. One of the most important metrics to look at, there are a lot of metrics you can look at, but return on assets, also known as ROA. And this is expressed as a percentage. It's basically net income divided by some form of the number of assets they have. And so these are all percentage numbers. We can see ROA in 2015 was about 12.5%. It's since actually moved up. It sort of fluctuates around. Last 12 months, it's dropped a little bit, presumably because net income has dropped because of the COVID crisis. One could dig into that. But I like to see good double-digit numbers here for ROA. In this case, you can see the ROE is really high, and then their book value probably went negative or something, which is why there are no values here. But if you just look at ROA, it can tell you that this is a business that can generate good returns on its assets. And then I'll take a look at the gross margins, operating margins, and net margins. It's good to see these are all healthy double-digit operating margins in the 20s to the 40s, net margins in the teens to the 20s. So there are no real, I like to see these double-digit numbers. I think the best way to explain what I'm looking for, rather than giving you real numbers saying, well, the net margin can never be at a certain level. So for example, Amazon has very low margins. That's their business. So you have to think about these operating numbers in the context of the business. But I think the best way to show you what good operating performance looks like compared to bad operating performance, and I'll link to both of these so you can do this on your own. But if we look at Alcoa, which is obviously in more of a commodity business, if we look at their return on assets, negative for many years or low single digits, quite negative in 2019, minus 7%, negative return on equity, gross margins are really in the low to mid-teens, net margins seem to be negative or negative or just single digits, 1 or 2%, usually less than 2%. So if you contrast that with McDonald's, you can see what a healthy business is, a brand business versus a commodity business. And when you have a good brand like McDonald's or Apple or Starbucks or something like that, you can charge a bit of a premium for your products. Whereas if you're just mining aluminum or producing aluminum, aluminum is aluminum. You don't really care where you get it from. But if you have a brand that's beloved by 3-year-olds and 83-year-olds, they can charge a little bit more money than your just corner hamburger shop that no one really knows no one knows what to expect. McDonald's, it's not gourmet food obviously, but when you go into any McDonald's around the world, you have a baseline for what you expect. And you know exactly what kind of experience. It's a branded experience, and so their ROA and their margins are very healthy, as opposed to a non-branded business that's more of a commodity. So that gives you a general idea how to do this. If you want to follow along with what I'm doing, you can check out my new service, Follow My Dividend Stock Portfolio. So starting this Monday, I'm going to buy my first stock. I'm going to be investing $100,000 of my own money, probably buying $2,000 of a new dividend stock once a week. So this will go on for about 50 weeks. And I may add money to it after that and continue to grow it. I'll be reinvesting the dividends. So you'll get to actually see inside my account, see which stocks I'm buying, what price I'm paying. And these will be a permanent portfolio that I'll be building, that I'll be holding probably for 20 or 30 years. Lord willing. So you'll get to see which names I'm picking and also how I'm thinking about the companies, how I'm analyzing them. So if you're interested in that, you can check out the link in the description notes below. You can just click to get access. Trade University Premium will give you this service. It'll also give you access to all of my courses. Learn to trade stocks like a pro, day trading, swing trading, options, futures. You can browse the courses here, and they're all included for the one low monthly price. If you're interested in this, you can scroll all the way down, click, you can go to the, go to the Join tab here, and then just click Get It Now. Now, normally 30 days access to all these services, including my dividend portfolio, is just $125 for 30 days access. But I want to give you a special coupon code. So if you click right here, Get It Now, it will take you to the checkout page. You can click Have a Coupon Code and type in YT, as in YouTube, 99. Because it looks like we're still in recession, I want to give you this coupon. You click Update, and they'll take $26 off. So you can get access to everything, including my dividend investing service. Again, this is not investing advice. You'll just get to see what I'm doing. But then you can think about it, consult your financial advisor, and decide what works best for you. But you'll get to see the names I'm actually buying. You'll be alerted when I actually buy them. And all of that, including the courses, 13 courses for just $99 for 30 days access. You can watch all the courses, cancel at any time, and you won't be charged again. There are no long-term contracts or anything like that. So if you're interested, check this out. If you don't want to pay a premium amount like this to see what I'm doing, you can always do something very simple, like just buy an ETF that has these Dividend Aristocrats, and you should do quite well as well. Hope you guys found this video helpful. If you did, be sure to hit that subscribe and like button. Let me know your questions and comments in the comment section below, and I look forward to seeing you in the next video. Thanks for watching.